Investing is a lot like planting a seed in the ground. You put the seed, it automatically takes root, you give it some fresh sunlight, air and water, and it flourishes into a beautiful plant and a tree. In investing, I try not to care about stock market predictions, complex algo trading system. Investing isn't just about trading pieces of stock certificates. Instead, I want to be looking at stocks as part ownership of a business with a durable competitive advantage that has a strong branding, intellectual properties, or even a wide distribution network. I want to be looking at businesses that has astute managers with a strong alignment with shareholders. But more importantly, I want to be buying these businesses at a reasonable price, then sit on my hands and do nothing. You see, I read a story about Ronald Reed. He was a guest attendant and later worked as a janitor in a shopping mall called JCPenney. When Ronald Reed died at the age of 92 years old, his family was surprised to have found out that he amassed $8 million in his name. Ronald Reed was a quiet multi-millionaire and he owned at least 95 stocks in his name. These businesses not only pay him dividends even after his death, but Ronald Reed had the patience and discipline to hold all these businesses for the long term. Now here's what I learned about Ronald Reed and it was very inspiring. Number one, Ronald Reed diversified his portfolio across different sectors: railroads, utilities, banks, and even consumer sectors. He led a very simple life. He doesn't let investing complicate his life. He drove a used Toyota car and he led a very frugal life. You see, investing is all about looking at the simple ideas that allow us to accumulate wealth for the long term. I want to just share a story about John Bogle. John Bogle is the founder of the world's largest mutual fund provider, Vanguard, and he shared a story which I'll never forget. Two famous authors attended a billionaire's party, and this billionaire is a famous hedge fund manager. So one of the authors said to his friend, you know, our host has made more money than you have made from selling your book in your entire lifetime. Now his friend just smiled and replied back, yes, but he would never have the things which I have. And you know what's that? And that's enough. We climb the corporate ladder, we aggressively chase our paycheck, and we strive to get promoted just so we can impress people. Right? We want a bigger house, we want a bigger car, we want a bigger watch, we want a bigger everything. But here's the thing, investing isn't just about accumulating wealth so that we can buy stuff to impress people. Investing is about accumulating wealth so that we can buy our own time freedom. For me, I want to buy my own time freedom so that I can spend time with my family, you know, attending my kids' Christmas event in school, bringing my family out on a weekend trip to Cameron Highlands. You see, if we keep shifting our financial goalposts and if we keep thinking that enough is too little, then we might actually take unnecessary risks in the stock market. Now there's a Chinese saying, there's always a bigger mountain behind you. That's never been so true. What we want is to measure by our own internal benchmark. Don't you agree? So I got an email from a reader a couple of years ago. She asked me, hey Willie, is it too late for me to start investing? So I shared this story with her. This story is about Scheiber. She was 51 years old when she started investing and she had $5,000 in her savings back then. When she died in 1995, her family found out that she had amassed a net worth of $22 million in her name. What's more important was she was able to accumulate dividends of over $800,000 and she reinvested back into her investments. Now, Scheiber, she was an IRS auditor for 23 years. As she poured through the taxpayers' statements over the years, she found out that only the very rich invested in stocks. Number two, she knew that she had little chance of getting ahead if she only had stuck to a job for many years. What I learned about Scheiber was this. She knew that it was never too late to get started, took investing seriously only in her 50s, and she committed to investing in stocks from then. Number two, Scheiber was a massive saver. She saved up more than 80% of her salary and put them in the stock market. Number three, she never gave up. At one point, Scheiber lost all her money from her stockbroker, who was also her youngest brother. But she never gave up and continued to commit in investing and soon compounded the wealth that she desired. She also knew that she only wanted to invest in high-quality businesses with a solid balance sheet that has growing revenues, profits, and have a very healthy financial position. 3 golden rules when it comes to selling. I used to read a book called Common Stocks and Uncommon Profits by Philip Fisher. The first rule was when a stock no longer meets my investment checklist. This means that for the underlying business, it has falling revenues, falling profits, and its competitive advantage gets disrupted. The business no longer has a strong branding power or it has deteriorating network effect. That's when I would actually sell my stock. The second one, when the facts of a company is no longer as favorable, I might get swayed away by the founder's smooth talk, misinterpreted the facts of a company, overestimated the business fundamentals. In this case, I would actually sell my stock. Now, the third point is when I want to look for better opportunities. Warren Buffett said to think of investing like a 20-hole punch card. If you had a lifetime of investment possibilities where you can only invest in 20 stocks, what are some of the highest potential stocks which you want to actually include in your portfolio? But here's the thing, readers have also asked me, is it risky to hold on to stocks that are overvalued? And my answer is this, I will actually sell a stock when its valuation gets too high, or what I call a rich valuation. What this means is that the stock goes up, the dividend yield drops. That's where I will actually sell the stock and reinvest it into stocks where there's a higher dividend yield. So whether a stocks go up or whether a stocks go down, this is how I invest for my portfolio, and this is the checklist which I use on when to sell a stock. One of the biggest income traps that investors make is actually what I call chasing yield. Investors only buy stocks with a high dividend yield without thinking about the fundamentals of the business. So they might buy into high dividend yield with very poor financial health. This will actually cause investors to lose money. The share price continues to drop. Investors continue to actually put in money and they end up losing money in a stock which might look like it is a big bargain. And the reason why this happens is because when a stock trades at a very high dividend yield with a deteriorating fundamentals, more often than not, many of these businesses tend to borrow money in order to pay dividends. However, when the company's fundamentals start to deteriorate and becomes unsustainable, management has no choice but to cut dividends, and this results in a falling share price. Now, in the early 2000s, General Electric took on very risky ventures. It ended up acquiring many businesses and its financial health started deteriorating. It ended up cutting dividends and its share price lost over 47% for its investors. So when it comes to investing, instead of just looking or chasing the high dividend yield, what we want to be looking at are accumulating very high quality, solid businesses that pays sustainable growing dividends and have a durable competitive advantage.